he concluded his testimony with a couple of paragraphs telling the senators that they must prosecute those who are responsible for the crisis. And he called it an existential issue for the United States of America, that the country either exists or not, based on doing that. And he put it in terminology such as, I think he said, you cannot rebuild markets unless you have a foundation of law, which I think we understand. Now, we have been fortunate in our work with economists, having run into and worked with some of the, and had benefits from some of the best. And it started with a fellow by the name of Nick Tiedemann, who was at a conference put on every year by Mason Gaffney. This one was at the American Institute for Economic Research. Mason, by the way, is the world's leading Georgist professor and economist. Nick got me into Mason's very elite meeting. I think there were 15 people there, including a guy by the name of Vickery, who about 2 weeks later was awarded the Nobel Prize in economics. So we've had that good fortune with Nick. The next economist that we really came into contact is here today also, and that's Professor Kaoru Yamaguchi. If you can stand up. Oh, Japan is right there. And Kaoru put our act, the American Monetary Act, and the HR 2990 through his advanced system dynamics. He's going to speak about that after Dr. Kumhof. And he concluded that it pays off the national debt, it provides the funding for infrastructure, and that solves the unemployment problem because you need all those people doing that work. And the third thing, does it without inflation. Now, our next great experience with economists is right here, and it's Dr. Michael Kumhof, and you've all seen these, sorry, I'm nervous, all seen these flyers which we have on the walls around the place. He's the Deputy Division Chief of the Modeling Division, Research Department of the International Monetary Fund. And he did something unusual. He took the Chicago plan, which had been created in the 1930s by our greatest economic minds, and they were great. He put it through modern computerized technology and made some discoveries, and he's going to tell us about that now. So please welcome Dr. Kumhof. Make sure the red light stays on. It's on, sir. It's on.
Yeah, thank you, Stephen. I have to say first, a disclaimer, I work for the International Monetary Fund. I can't just run around and say certain things and then say that they represent the IMSU. So this paper certainly does not. This is a research paper. It does not represent any official policy positions of the IMF. It's jointly written with Jeremy Bennis, with whom I'm writing a whole series of papers about banks these days. So the plan of the talk, I'll give you a very brief introduction. Then before I delve into a model, there's actually a very elaborate model behind this that is written using the techniques of modern macroeconomics. But the modern macroeconomics gets banks wrong almost 100% of the time. And we fixed that in this paper. So that's the major difference. It's a model of about 100, 200 equations. But I'm not going to talk about that. I'm going to talk about the big conceptual issues of how should I be modeling banks, and then what comes out of this model once we simulate. What are the major economic insights that you get once you put this understanding of banks to work in a model? Right? The technicalities, you can read the paper. It's 85 pages long. And so then I will go through the advantages of the Chicago plan, both the ones found in the 30s and ones that we found more recently now in work. Then there are some questions that I have been bombarded with since August last year when this paper came out. Some of them less important, some of them more. The most important ones I'm going to briefly talk about, then a summary and discussion. So, the Great Recession has obviously revealed enormous weaknesses in the financial system, and it has triggered some reform, but the reform that we have seen has been mostly piecemeal fixing the existing system, patching it up. My reading of history that started in about 2005, I'm a former banker and I was very interested in monetary history, quickly led me to the insight that, you know, in the 1930s, the thinkers and reformers at that time were actually far more profound thinkers than anybody, almost anybody, out there today, in terms of people who are thinking about how to reform the monetary system. There are some very clever minds out there working on this these days, but it's all about patching up the existing system. The people in the 1930s were really thinking about what is money, what are banks, and given that, how could we design a system from the ground up that would work differently and that would not have many of our problems in the first place. And so these leading macroeconomists that I list there under the third bullets were all supporters of the Chicago plan, and note that these were the founders of the Chicago School of Economics, some of them, most of them. And the Chicago School of Economics is free market, laissez-faire, etc., on industry. In the 1930s, it was not laissez-faire in finance and money. That only started much later, and that was a big mistake. Right? So what the Chicago plan proposed is the separation of the monetary and credit functions of banking, which means as far as money is concerned, deposits must be backed 100% by public reserves. And as far as credit is concerned, it remains a private activity, but it cannot be financed by the creation of bank deposits ex nihilo out of thin air. And I'll get to that, how that works. All right, so the key insights. First of all, the key function of banks in today's economy is money creation, not intermediation. And if you look at academic models of money, they will all, almost across the board, model banks as intermediary that take something from somebody and then intermediate it on to somebody else. That is nonsense. It is literally nonsense, and I'll explain to you why. So the key function of banks is the creation and destruction of money and to provide check clearing services of the money once it has been created. And once checks clear between different agents, it looks exposed like intermediation has happened. But this first step, that you take somebody's money and then pass it on to somebody else, that never happens. It literally never happens. Okay? So are they also intermediaries? The common definition of intermediation is the one I just gave you, and banks are just not intermediaries under that definition because loans come before deposits and not the other way around. And here is a little story of how I like to explain this. Let's try to think about banks as intermediaries. Okay? And I'll construct a scenario for you where A, some guy or some lady wants to buy goods or assets, and B wants to sell goods or assets. Right? The intermediation story goes, B goes to the bank and dumps the goods there, the physical goods. And then a deposit is recorded. The bank then gives the goods to A, and a loan is recorded. This is literally how you have to argue if you want to say that banks are intermediaries. Because it implies that deposits become before loans. What you have to ignore for this, by the way, you could say, oh, but banks also take checks, etc., not just the goods. The checks is something that happens between a lot of heterogeneous banks, individual banks. For the banking system as a whole, when somebody deposits a check, it doesn't change anything. The amount of deposits in the aggregate banking system remains the same, and the amount of loans remains the same too. So that has nothing to do with it. Cash deposits are very tiny, so we could actually ignore them. The system would work exactly like it does today if we didn't have any cash. But in any event, banks never literally lend out cash. In the sense, when they make a loan, they never lend out cash. They make a loan, create a deposit, and then you can draw cash against that deposit. That's a different story. Okay? So the intermediation story that people try to tell you is physically impossible. Money creation, the same scenario. A wants to buy goods, B wants to sell goods. A goes to the bank to get financing, and B stays at home. He has nothing whatsoever to do with this. Okay, I'm a bank manager. When I tell this story, a former bank manager, when I tell this story, I remember physically how this works, right? This is not some sort of academic story. A gets a new loan of $1 million at that moment, that if he's good for the loan, and the bank manager says he's good for the loan, and the bank records a loan on the asset side of its balance sheet, and at the very same moment, it records a deposit on the liability side of its balance sheet. And this is new money that the bank has created out of thin air at that moment. Nobody had to come to the bank first to give it something first so that the bank could then give it to A. This is all between the bank and A. There is no B involved in this transaction. Okay? Of course, this is an absolutely extraordinary privilege that there's somebody in the economy out there who can create their own funding out of thin air. Nobody else is allowed to do that. Anyway, A can then use this deposit that has been newly created to pay B, and then it might look like intermediation has happened because there are different people on the balance sheet. But at the moment when loans grow, there's no intermediation. Right? Okay, so that's an important insight. What's the implication? New loans involve no intermediation. No funds are being withdrawn from other uses because somebody is saving in order to give it to somebody else. This whole story about do you have to have savings so that you can have investment is also nonsense. I'm not going into that because I don't have time. So banks can easily start a lending boom with this system because they simply have to grow their balance sheet by the same amount on both sides because they don't have to attract anybody's deposit first. There are constraints on this. I'll get to that, but they are not what most people say they are. So it also makes no difference if this deposit that the bank has now newly created gets withdrawn and deposited at another bank. Unless one bank gets really ahead of the pack and lends very, very fast relative to everybody else, and then they might get into trouble because they can't get enough funding in the interbank market. But if they all do more or less the same thing, then if I lose a little bit of money from somebody withdrawing his money, I'll get it back on average from somebody else who is depositing with me, and if not, I go to the interbank market. No problem. Okay? Reserves or cash balances impose absolutely no limits on this process, and that's my next point, and I'll get to that. The only constraint on a bank is this loan profitable? Is this loan, and on average, and also are there very high tail risks so that if I make a very large loan to a very risky customer, might I sink my whole bank, my whole institution? And the attitudes of banks towards that, to the profitability of loans, depends on their attitudes of where is the business cycle going. And that is a very volatile sentiment. And so banks, with their moods about where the economy is going, can create upswings and downswings in the credit cycle. And that mood is what constrains the banks. Nothing, almost nothing else. There is monetary policy to some extent, but it's very weak. This is one of the most beautiful quotes that I've ever seen about this whole story, and I actually, this one I like to read out in full because there's so much meat in it. And by the way, I discovered this half a year after I wrote the paper, and I felt very vindicated. This makes it hard. This is Schumpeter writing in 1954, talking about the theory of banking that had been developed the previous 5-6 decades. It makes it highly inadvisable to construe bank credit on the model of existing funds being withdrawn from previous uses by an entirely imaginary act of saving. It's imaginary, okay? And then lent out by their owners. It is much more realistic to say that the banks create deposits in the act of lending than to say that they lend the deposits that have been entrusted to them. And then we go into theory, into history, the history of economic thought. The theory to which economists clung so tenaciously, and by the way, they're doing exactly the same today, makes depositors out to be savers when they neither save nor intend to do so. attributes to them influence on the supply of credit, which they do not have. So, and then he says it proved extraordinarily difficult to persuade economists that this is not how banks work, and that the story that I just told you is how banks work. But by the 1930s, people had realized that this is how banks work. All the major economists had realized it, and those were the same people who came up with the Chicago Plan. And in some sense, if you go into this history, we are right now in the history of ideas back at pre-World War I in a level of understanding of banks. And we're having to relearn the lessons that these guys had to learn through the Great Depression, because for a period of about 30, 40 years, people just didn't pay any attention to banks in macroeconomics. None whatsoever. Okay? Now, money creation, here are some supporting statements by central banks. The story that I just told you is on this slide, basically exactly like I told it to you almost. It's from the Federal Reserve Bank of New York, the governor of the Central Bank of Canada from back in the 30s, Bank of England 2007, Bundesbank 2009. You can read this in many, many central bank statements. It's a bit hidden, it's not front and center, but it's very, very clear. All right? Now, the deposit multiplier, do the reserves that the banks have to hold, or in some cases decide to need to hold for business purposes, do they impose a constraint on this ability to create credit and thereby money? It's a myth that it imposes a constraint, and this terminology goes back to Nobel Prize winners Kittel and Prescott, also very conservative economists, by the way, not monetary economists, however. The deposit multiplier, the story goes that the central bank fixes some quantity of narrow money, and then the banks multiply that by lending it out and keeping a certain fraction of it. You know, we've all seen it in the undergraduate textbooks. I don't need to go through that. So why did Kittel and Prescott call that a myth? Because it's actually upside down. It's completely the wrong way around. It's the opposite is what happens. Okay? In the monetarist era, they found that broad monetary aggregates lead the cycle, and that those are the ones that the banks create, and narrow monetary aggregates lag the cycle, and those are the ones that the central bank provides. Okay? And this is by 3/4 the lead and 1/4 a lag. These are not Kittel and Prescott figures. This is something I got from Steve Key for more recent data. Okay? Inflation targeting era, it's even more fundamental. And that's today, right? If you control a price, which in our case here is the interest rate, then you just have to let the quantity adjust. So if you set the federal funds rate, then you cannot just go out there and not provide the reserves that banks want at that rate. Unless you're Paul Volcker and you want to go you really want to double down and do something really extreme. I presented this work at the Fed recently, and they said, you know, what you're saying is right, but there was a short period in 1980 when Paul Volcker did exactly that. Okay, but those are extreme periods. Okay, so here are some central bank statements that support what I just said here too. This is Vice President of New York Fed, 1969. This is the clearest statement that you can find. In the real world, banks extend credit, creating deposits in the process, and look for the reserves later, afterwards. Okay, and the Fed will be happy to oblige. In fact, it's almost legally required to oblige because it has to guarantee the stability of the financial system. Right? This is a working paper from the Fed itself. The relationships implied by the multiplier do not exist in the data. Textbook treatment of money can be rejected. This is a very recent one from the ECB. The Euro system, however, always provides the banking system with the liquidity required to meet the aggregate reserve requirement. I mean, it couldn't be any clearer, right? And this comes from the horse's mouth. All right. So the conclusions of the deposit multiplier and what I said before: when banks ask for reserves, the central bank obliges. The transmission always starts with loan creation, that leads to deposit or money creation, and then the reserves come afterwards. It puts the banks almost fully in control of the money creation process, except through the federal funds rate. The Fed does have some influence, but as I said in context of the Volcker story that I told you 2 minutes ago, during normal times, the Federal Reserve will not use that mechanism in such a brutal way that it actually is stronger than the ability of the banks to create the credit that they want to create. It will affect it at the margin. But if the banks are determined that this economy is good, our borrowers are good, we want to lend, then whatever the Fed does is only going to have a marginal influence on that. Okay, now, armed with those insights, we then went to build a model of, a business cycle model of banks embedded in a modern DSG, new Keynesian model. Okay? And we wanted to test whether what Fisher said in his beautiful little booklet, 100% money and the public debt, whether that was actually supported by a modern analysis. And it is. And he found dramatic reduction of the net public debt, dramatic reduction of private debts, complete elimination of bank runs, much better control of credit cycles. And what we found in this paper is that all of this is true, and I'll show you why. And then large output gains we found as well, of up to 10%, and elimination of liquidity traps, which, you know, for anybody who watches monetary policy debates these days, that's a huge bonus. Okay, so now I'm going through the detail of why we get these advantages. And what I put front and center is the reduction of debt. Because in order to explain that, I need to explain what's happening to balance sheets, and that's absolutely critical to explain, to understand the Chicago plan. In fact, a lot of people out there have in the past sort of talked about, oh, we should do that kind of monetary reform. But it is always very hard to understand for somebody who is trained as, let's say, an accountant or a banker or something, to understand what does that actually mean in terms of balance sheet. How could we go from here to there? So the big benefit of the model that I've built here is that this shows you exactly how you go from here to there. So we start with a carefully calibrated balance sheet of the aggregate US banking system, where all numbers here are in percent of GDP, US GDP. This total balance sheet adds up to 200%, that's rounded of course, and it's based on roughly 2006 data prior to the Great Recession, right? And it includes the commercial banking system, which is a little less than 100% of GDP, and the shadow banking system, which is a little more than 100% of GDP, and so they add up to about 200%. And what we have here is deposits and bank equity on the liability side, right? Liabilities is always is actual liabilities, but also the own capital of the institution. Then we have investment loans, a little bit of government bonds. Most of them are not held by the private banks, but elsewhere. And then we have short-term and mortgage loans. Okay, what is the Chicago plan? The Chicago plan says, I go to the banks and I say, you have all these deposits here, but they're not backed by public money. Now they have to be. Okay? Where does that money come from? It comes out of thin air. Just like the banks created this out of thin air. Right? But now, this seigniorage that the banks have collected in the act of creating this money in one instant is transferred to the government. So how does this work? Basically, you have to back these deposits by reserves 100%, and in order to buy these reserves from the government, you give the government an IOU. It says, I owe you, the government, 184% of GDP here in order to obtain these reserves. That's step one. Then what we do is just essentially rearrange this balance sheet into two separate banks. Nothing, the individual elements are still, the numbers are exactly the same, I've just rearranged. Here we have money banks where reserves and deposits are on opposite sides, and then we have the credit investment trust. This is basically a money warehouse. It's like having an account, like we have an account directly at the central bank, but it's not like that here because there's an intermediary that manages our accounts, and it's private, and it can compete by providing, you know, competitive, attractive payment services, etc., etc. And the economy needs that. It's very, very important, right? And so we leave that private, but it's all backed by reserves of public money. The rest now is the loans. All these loans are still here. They are still financed by the original bank equity and by treasury credit. But that's only the beginning of the story. People like the post-World War II free market Chicago types will jump up and down and say, oh, this is the government getting into the credit business and that's terrible and blah, blah, blah. That doesn't hold up because we're not done. So the next step is to say, look, the government now has this huge, it's essentially an enormous bank account in the banking system, like a huge deposit. Like the banks owe the government this money. And what the government can do with that is, for example, it can repay government debt as it falls due. It can basically cancel the government debt that's held by private banks against these liabilities of private banks, and the credit investment trust balance sheet gets shorter. But that's only the beginning. The next step would be to say, look, the government still has this huge bank account, it now shares it with its citizens. Everybody gets an equal per capita dividend, citizens' dividend, that's equal to 100% of GDP. So everybody, every single person would get the average annual income as a one-off citizens' dividend paid into this account. So we would then have citizens' account here. Okay? And I made it equal to 100 so that it just matches this, because then you can nicely illustrate that you can use this to repay certain types of loans. The stipulation here would be that if you get this citizens account, you have to use it first to repay any outstanding debt that you might have. And so we're making it such that these citizens accounts are just sufficient to repay all outstanding short-term and mortgage loans. So this will be consumer loans, mortgages, and it's also in this particular application working capital loans by firms. But they are relatively small part of that. Okay? And then we have this balance sheet. Credit gets smaller. Then we have a little step that's only of interest in passing, is the bank now has a lot more equity than it needs under the Basel regulation, and so it would pay this out to its shareholders, the excess equity, so the proportions on the liability side change. You still have a balance sheet here where what is left, which are investment loans, loans for financing factories and machinery, are financed by the government to a significant extent. Doesn't need to be. Because what you can now say is, look, this treasury credit could also be used to prepay or withdraw from circulation any of the government debt that is still out there, that was not originally held by the private banking system, which was around in 2006 about 60% of GDP. If you did that, you would end up with this kind of balance sheet where the investment loans are financed by a little slice of bank equity, a la Basel rules, a little bit of treasury credit, but only at the margin, and long-term, non-monetary private deposits. Because it's important that these are not monetary, because you don't want these investment trusts to start creating money again, right? So this must not be a substitute for this. And that's an important practical concern. But in any event, the government is not, in a major way, financing credit if you don't want that. That's not a necessary part of the Chicago Plan. Now, the government's balance sheet. And here we're saying this is the government's balance sheet prior to the Chicago Plan, then after 100% reserve banking is established, and here's the final position. There were government debt of 80% of GDP initially. That was roughly the number in 2006. And I have some other net assets, doesn't matter what they are, I just wanted the balance sheet to balance. Now when we do the Chicago Plan, the government issues these reserves and has the treasury credit claim on the banking system. All right. Now, here is a very, very important, I always do a visual, here's a very important thing to remember. This money here is not a liability, not a debt of the government. Okay? This, so I always, I only have 1 cent here, but okay, that's enough. This is debt-based money. Because this is debt-based money just like bank debt-based money, because on the other side of the Fed balance sheet is government debt. So this is also debt-based money. But this, the smallest one there is, this is not debt-based money. This is treated, and I thank Jamie for that because he found that out, in the official accounting conventions of the United States, this is treated as a one-off revenue. In other words, this is equity in the commonwealth of the nation. Okay? You cannot ask for repayment of fiat money in something other than